me see if I want. All right. Ready to go?
I'm ready.
Okay. All right. Well, welcome. My name is Jennifer Lamp, and my company's Radiant Financial Group, and I'm a senior residential mortgage advisor. And it is my pleasure to introduce you to Jesse with my credit guy, who is also a valuable team member on my team, where I send clients to get the credit support that they need to be able to qualify for a home in the near future. Jesse, introduce yourself.
Hi. Yeah. So, as Jennifer had mentioned, Jesse with My Credit Guy, I've been with the My Credit Guy team for um, just over 4 years now. And my focus, specifically in my role, is to help loan officers partner with uh, clients that have a desire to become a homeowner, but they have challenges related to credit and come up with specific game plans, strategies, and timelines to get all of those clients back to Jennifer with improved credit so they can move forward with following through with the American dream of becoming a homeowner. And so we've got a team at My Credit Guy of roughly 50 people that all have different responsibilities within that process to be very hands-on with our clients to help them improve their credit situation.
Wonderful. And my credit guy is my absolute go-to partner for anyone who has any real deep credit needs. They have done an incredible job in the past of taking somebody who was not even close to being able to qualify for a home and walking them through the process of cleaning up the credit, trying to clean up some bad, past mistakes, and then getting their credit completely reestablished and a score that we can lend against. So we appreciate you as one of our team and one of our partners.
We appreciate you as well. It's one of the things that's very enjoyable about what we do is that when the only way that things can go well is for it to be a team approach, right? Loan officer, sometimes a real estate agent involved, a potential borrower that's very motivated to become a homeowner, and us to help and leading that path for credit improvement. So it's always a team win, and it's always very, very exciting. And the one thing I'll say is that you referenced where you've had a scenario where somebody was very far away from that point of qualification, but we got them there. And I think that a lot of times when people are in situations where they're challenged or their credit is challenged, they feel overwhelmed and they feel like there's no, because of that feeling, they usually land in a place where they say this is going to take forever, or there's no way that I'll ever buy a house. And there literally has never been a time where I've looked at a credit report where I said we can't do this, right? Like the only change is like how long it's going to take, right? And the other thing that's very surprising a lot of times for people is that time frame thing, right? Like even the worst of situations that I've seen, I've had people come back within 8 to 12 months and put themselves in a position to get pre-approved for a home. So once we start to allow ourselves to see that detail and communicate it, that's when I think people actually see some light at the end of the tunnel. So for anybody that's feeling overwhelmed, just know that once we make those initial assessments, it really is not as bad as usually what people think. 8 to 12 months anymore seems like not that long at all, right? So
No. And I love what you said, because we take a very similar approach. It's never a no, you can't buy. It's just a what do we need to get you to be able to buy? And it's all about creating this strategy and walking you through step by step. And that's what we do together. I always say it's no borrower left behind. It's
yeah,
always solution mind. Every single person can own. It's just a matter of putting the pieces together to get you in that place where you can qualify. So I love that approach that you're taking.
right. Yeah. And Jennifer, I mean, that's really a good representation of who you are and how you operate your business as well. Because I can say from my perspective that not all loan officers take that approach, right? Like it really is, it's not a a requirement or a standard that somebody cares about helping somebody fix their personal situation. There's a lot of people that operate within our organization, or excuse me, within our industry that good luck, right? When you fix your credit, come back this way. I'll take care of you when you fix that. But there's not everybody's willing to help through that process.
Yeah, I think I always say, don't call me a loan officer. I'm not trying to push you into a loan. I'm a mortgage advisor. I'm here to be a part of the team that helps you to advise and plan and think 3, 5, 10, 15 years ahead,
Right.
towards all the goals, the financial goals you have. And my focus is primarily on the residential mortgage side of it, but I'm one of many team members that helping you to accomplish your financial goals. So, um,
Absolutely.
all right. Well, should
Good.
we jump into some good and exciting credit wisdom coming from the
Yeah.
great credit guru, Jesse?
Yeah, absolutely. I'm ready for it.
Okay, perfect. So I've got a few questions. You just, we'll go through them. My first question is, what can make the quickest and biggest impact to your credit score? So these are a lot of people listening are going to be real estate agents, consumers, and and I was thinking about this morning. Do you ever have conversations while you're getting ready in the morning?
Yes, with
In
yourself.
your head, and
Always.
not like literally
Absolutely.
talking to the
All
mirror,
day.
but in your
Yep.
head.
Yeah.
Okay, this morning I was like, this industry is it's hard to be a buyer in this world because we have a whole language and a vocabulary, and there's so many moving parts and so many people involved in a real estate transaction, and it's overwhelming. But honestly, when I narrow it down to one of the most overwhelming aspects of buying a home, it can be the credit side of it, because
Right.
there's so many confusing, like, what do you do? Where do I even begin? And
Yep.
so many people feel like I don't even know where to start, so I'm just
Yep.
going to give up on the hope of ever being a homeowner.
Yeah, but that's what we run into a lot, right? If somebody currently can't move forward because their credit score isn't high enough to get just a standard minimum qualification, that's usually the next thing, which is why like when we make that transition, that's the first thing we do is a review, right? Like we want for that client to go through a full review of their credit report so that they understand it and then they can walk alongside us and understanding here's the plan to fix it. Like we want them to be a part of it. We don't just want to do it for them. We want to change that understanding because that's where we're meeting people all the time where they're going, I don't know what to do next, right? And
Yeah.
so there's a lot of it's interesting about answering these questions, right? Of like, what's the quickest thing that you can do? Is that like really it's not just one, it just depends on the situation. But the answer that I'm going to give is going to be what I see most often can be done the quickest to make the most impact, right? And that is paying down credit cards. I would say that right now, because again, let's go back just a minute here when you're talking about what do we do next, right? A lot of people, there's some situations where they say, how do I get to a point where I can get qualified? Some people are like, I can get qualified at this credit score, but what impact will it have if I raise my score 40 or 50 points, right? There's always a what's next or what happens differently. And I truly believe that where you make the most impact in either of those situations, if you have credit cards and you have some opportunity to pay them down, that is going to be the quickest way for you to increase your credit scores. And that's because a couple things. One, credit cards are the second largest impact within the algorithm, right? There's 5 sections of the credit scoring algorithm, and number two is your debt utilization, your credit utilization. It's 30% of your score. It's just second to the number one, which is payment history at 35. So that's a big reason. The other reason is that people often misunderstand what the grading scale, so to speak, would be as it relates to what percentage your utilization is at. For example, if somebody said, I've got a credit card that's $1,000 limit, but I only have $750 of it used, you could go, that's okay. And the answer, really, the reality is you're great. Like you haven't missed a payment. You're on time every month. You're not even work. You still have lots of room before you're above your limit. You're a great customer to that credit card company. They're making interest off of you, right? You're making your payments every single month, but you're not serving yourself in that because essentially the FICO scoring algorithm says that once you hit 50% of that threshold, so in that situation, if you've spent over $500, you're suppressing your score. That becomes that and puts you in that risk category. So what we talk about at My Credit Guy is the good, better, best credit utilization process. Less than 50 is good, less than 30 is better, less than 10% is best. So most people are not carrying credit card balances that are traditionally less than 30%. It's almost never, right? Until they get educated to understand that once you start paying those down, it can make a significant impact to where your credit score stands. So I would say that's for sure the number one and most quickest, most effective way to increase credit.
Awesome. Let me just add to that. One of the things that I get, one response from new clients I get is I'll reach out to them because they say they're interested in potentially purchasing a home. And then I get a pushback and they say, no, no, let me call you once I've paid down my credit cards and then we'll start the process. And as much as I love that, that's not necessarily the best time to have that first conversation with a mortgage lender, because there is an absolute strategy when it comes to paying down credit cards. And there's a lot of different aspects of that you want to consider. First being, what is going to impact my credit score the most? And then what do I need to have paid down to qualify? And those
Right.
could be two different things. There are a lot of times when somebody thinks they need to pay off all their debt and it doesn't have any impact on them qualifying for the house that they want. So, getting with your team members, a mortgage advisor, and with you, Jesse, and having that advisory, talking through what impact actually matters is going to be that first wonderful conversation. So,
Totally. I mean, it's always let's see exactly not just what the credit looks like, but how it applies to the options you have for them, Jennifer, right?
yeah,
Because if we were to tell somebody, listen, hey, you're not going to pull, credit today because you do have some things to clean up. So you're going to go spend $5,000. And then when you come back to me in a month or 6 weeks, the only thing that will have changed in your situation is that you have $5,000 less in cash because it did raise your credit score, but it didn't change your rate. It didn't, it didn't move you to a different qualification status. It didn't allow for you to borrow more, right? So you simply really just took $5,000 and pulled it out of your pocket. And yes, paying down credit card debt is good financially. But if it doesn't put you in a better situation with the goal that you have of becoming a homeowner, why would we spend it? Because there might be a different place for us to spend that $5,000 and the whole grand scheme of getting you the best deal and the best situation. And once you pay that money towards credit cards, the only way that you can offset that is to spend more money on the credit cards that you might have spent with cash, right? And so it just doesn't make sense to go to all that trouble, right? Spend all that time just to find out it's really not changed the outcome of your opportunity.
right. And I think that's the most important thing is information is power, is just
Yep.
having the right information to be able to make the decision for yourself as to, what the next best steps are. It very well might make sense for a client to pay off all their credit card before they feel comfortable enough to purchase a home. And
Sure.
that maybe extends 6 months or 12 months out from buying. But we talk about all of that in that initial loan consultation. And so it's just really important that you don't delay that first conversation, but the information you're going to get during that conversation is going to give you the strategy on where to put your money and how to do it well.
Absolutely. I totally agree.
All right. Well, let's go to the next question. So, next question is, what changes can we expect in the next 12 to 18 months with credit scoring models and how it will affect the mortgage industry? This is an interesting question because to all my realtors out there, you need to be listening to this particular discussion because your borrowers and the way you advise your borrowers or your clients, your buyers, is going to be affected by this. So, what is going on with credit modeling and what should we expect?
At a high level, here's what's happening on the professional side of things for what we'll experience for a loan officer and for a real estate agent. We're going to be looking at different credit scoring models, right? So they're essentially different products. We used to today, right? Like we pull a credit report that shows us a tri-merge, which is a credit score and history from Experian, TransUnion, Equifax, produces 3 scores. We use the middle score. It's called a tri-merge. We're moving away from a tri-merge to a bi-merge. There's a lot of questions that we don't have answered yet on how we get to that, 2-score credit report that we're going to work from. More to come because this isn't rolling out until next year. But it's not just going to be, a score for Experian, TransUnion, Equifax. It's going to be FICO 10T is the new product that they've rolled out for FICO, which is the T stands for trended. And then the Vantage 4.0 scoring model, which is new to the mortgage side of things. Vantage Scoring Solutions has been producing scoring models for, I don't know, roughly 15 years now. I believe they were established in 2006. And those products most commonly have been seen on consumer credit programs or applications, right? So Credit Karma, for example, when you see those Credit Karma scores, those are Vantage 3.0 scores. So this company has created the model Vantage 4.0, which will be applied to mortgages. So that's the big change that we're going to see as far as what it is that it looks like in the products that we're getting access to. The details of what's changing as far as what's reporting, how it's reporting, and how it affects our clients is there's more detail there. One, they're looking more at a very specific scope of 24 to 36 months on a trend. We are now going to see that your cell phone bill, utility bill, rental history, all of those things now are going to be reporting consistently to credit, and they will impact either positively or negatively the credit score. So sometimes today, Jennifer, you'll see, you know this better than I do, you'll see trade lines that show utilities, and we usually have to exclude those. There's not a lot of detail. They're usually only with Experian because the client used Experian Boost, and it has no impact on the credit score. It just
Right.
makes the file messy, right? In the
Yeah.
future, it is going to have an impact on the score, which means that it's super important for us to be communicating to people. Hey, guess what? Your electricity bill, if you don't pay it on time and it goes 30 days late, that's going to get kicked to the credit bureaus and your score is going to go down. So before, we've seen things like that on a credit report, but only when they get to collections, right? So now they're digging into like the actual reporting related to how people are managing those counts before they get to collections. And a lot of them, it's that they never do get to collections. They're just getting good credit for that. So you can look at this from a positive perspective to say, like, we really have an opportunity to build credit in other ways now that we didn't before. That's going to contribute towards a good credit score for a mortgage. But then we also have to see the flip side of things to say there's more to manage now. There's more to understand and keep track of and make sure that we're on time so that we're not, you know, putting negative things on our credit.
So one of the things that I know is important in having overall a really successful credit profile is the variety of different accounts that you have. It's not just having 5 revolving accounts. When they implement some of these new accounts, will that give a variety of different type of accounts, which will help people
Oh
to
yeah.
build credit?
Yeah.
Okay, so
Yeah.
talk
It's
about
called
that a
mix
little
of
bit.
credit, right? It's
Yeah.
responsible for 10% of your score. And so now there's instead of just an installment loan, which is usually a car or a personal loan, a revolving, which is a credit card, a mortgage, which is a mortgage. And I mean, what else? Like personal loans sometimes will pop up on there, student loans, but now we can expand on what truly can be used to establish a mix of credit for sure.
Okay, and when did you say this is going to roll out?
It's scheduled for Q4 of 25. So next year, say October, is about it's it's one of those things where it's a moving target. It's been moved 2 or 3 times now. There's been no talk of it being extended up until this point, which is, we're still not necessarily quite within that 1 year range. It wouldn't surprise me if that was, but it seems like there's enough in place right now with the testing that they're doing and the work towards what it'll take to do a full implementation, that if we're not right there at Q5 Q4 25, we're not going to be far off from that.
One of the biggest questions I get from a lot of my clients and realtors is why is the credit monitoring service credit score so different from at times from the score that I pull when I go to pre-qualify a client? Can you explain the difference, and will this model change actually narrow that gap a little bit?
Yeah, good question. So the main reason today that is when you pull a mortgage report, it's through the FICO scores number 2, number 4, number 5, right? So those 3 credit scoring models are applied to all the data and history of someone's financial past, and they produce 3 different credit scores. The reason that when you pull a consumer app, again, most any of them, is because they're using that Vantage 3.0 score. That's a completely different scoring model than the mortgage report that we're getting access to. So it's just a different grading system, right? And it really is as simple as that. And so to answer your question, are we going to be able to narrow the gap when we move to the new scoring models? The answer probably will still be no, because FICO, and I'm assuming that Vantage Scoring Solutions doesn't necessarily like to make their specific products that are built for lenders to assess risk, essentially, uh, uh, accessible to consumers, right? Like it's in their best interest to have a variation because that means that there's more to sell, essentially.
Yeah.
So it's very important for our consumers to understand what the difference is.
Okay. And for consumers out there who want to monitor their credit well and have a really good perspective of all three bureaus, is there a monitoring service that you recommend that you like the best out there? What would you recommend for them?
There's two that I like. One is it's good and consistent, and it's very low cost in my opinion. It's 19.99 a month, and it's called Identity IQ. It's what we use for like all of our clients that go through credit improvement are usually on that specific program. So it's a good solution. Identity IQ. You're going to see the Vantage 3.0 scores on there, right? The only other one that I like, and I would say is my favorite, just because of how thorough it is, but also comes with a premium price tag, is myfico.com. They have an app, they have a website, but it is straight through FICO, and it gives you access to their FICO 8 scoring model. That's a consumer scoring model. Their 10, and then also there's a specific section where if you have an account with them, you can click the mortgage credit scores, and it'll show you the three mortgage credit scores that you have that are applicable. Now, you get a lot of information, and it's all very helpful, and I think it's very valuable, but you're going to spend anywhere from $40 to $50 a month to have access to that.
Okay.
So for somebody that's thinking about purchasing a home and credit's very important, I think that $40 to $50 investment is worth it on a monthly basis, right? Like maybe not after you've purchased the home, maybe then you could just use the 20 or 15 or $20 application, sure, but just the power and ability to truly know what your scores are based on what you're applying for, like a mortgage, I think is just it's worth the additional money, no doubt.
Absolutely. Okay. And you said both Identity IQ and MyFICO both monitor all three repositories?
Yeah, all three bureaus. Yep,
Perfect.
correct.
Okay. Good to know. All right. Thank you for a great information. All right. Our third question is all about misconceptions. What are some of the top misconceptions or the most common misconceptions that you hear on a daily basis?
I'd say there's three that are super consistent. This is like the easiest question for me to answer because they're everywhere on the internet. But we've talked about one so far, and I think it's important to bring it up again. And it's that if you have credit challenges, if you have bad credit from the past, that it takes a really long time to get it fixed. It's not true, right? Our average customer works through our program in 3 to 5 months, and the super aggressive cases, again, like we talked about earlier, could take 8 to 10 or 12 months. But we need to recognize that that's not forever, right? Now, there's going to be some challenging things that we have to work through, right? There's going to have to be some acceptance of some things that we did in the past, some learning opportunities. We're going to have to fork out some money to get some things fixed, but it's all for good purpose, right? But it's still definitely doable. So I think that's the number one thing that I hear. Another one would be there's this little like there's so many of these like, ooh, come to my TikTok to hear the loopholes of how you build credit, right? Like there's so many of them right now. And one of the ones that's like a super hot topic is hack the credit card system and increase your credit aggressively by making certain payments on certain days throughout the month. Instead of making one minimum payment, make three, right? Boom, boom, boom at different points. They're trying to make people think that they're like, if you do that, that it's adding payment history 3 times a month.
Yeah.
But the truth is that that information usually only is reported to the credit bureaus once a month. So when you do those three events, all you're doing is just updating your balance 3 times before they send the result of it up, right? So I don't know where they come up with some of this stuff. I also don't understand how people gravitate towards it so much, and it just isn't true. What is true is that paying your credit cards on time and ensuring that they're maybe set up on auto pay so that you don't miss a payment is incredibly important to ensuring that your credit stays healthy and that it continues to grow. There's no question about that. But the old your alarm for 11:30 at night for the 16th, right before Capital One's, no. It's like no. Nope. Just pay your bill, right? Do it on time. It's pretty simple. And then the third one I would say is is probably that there are credit repair companies out there that can get rid of anything, right? Like the stuff that I hear about, like, oh, this guy says he can get rid of a bankruptcy and act like it never happens.
No.
Not happening. Or that late pays are really easy to get removed, or this or that. Like, nobody can guarantee anything. We're constantly negotiating with creditors on what they will allow us to do, right, to resolve an account. And it's ever changing, and it's never just as simple as, I guess I'll expand on this. There's some credit repair companies that say, well, like, I know somebody at Chase Bank, so I have an in on getting that. It's like, no, maybe, maybe, right? But like, it's just, I've never seen it actually be the truth. And so, like, if it sounds too good to be true, it probably
Probably
is,
true.
right?
Yeah.
Yeah.
And
So
doesn't
I
it
would say,
really, oh, I'm sorry, I didn't mean to cut you off. I was just saying, doesn't it really sometimes just come back to the basics, is just doing the right thing?
I mean, honestly, it kind of always does, and not just in credit. It's like everything, right? Like, it really is. Like, for us, we get to the point where there's a lot of, like, where clients, as they continue to learn, they're like, I could have done most of this myself, and it's like, what's amazing is that you're right. And now that we've worked together, you're gonna be able to do most of this yourself in the future because of what you've learned. And so we have to get to the point where we're valuing even the ability to be led through a process to understand something better. I mean, Jennifer, you and I know this because of our industry. It's like there's a lot of coaching and leadership and motivational, like, events that you go to, and there's value there in personal development. There's no question, right? And so we see it a lot. We even maybe personally I've personally done it, and I'm sure that you personally have as well. You're paying for, professional development because you know that it's going to be good for you and good for the people that you serve. That is also true in, like, what people are paying us to do to lead them through understanding how to handle their financial situation specific to credit better than they do today, right? So it's just tough a lot of times to be able to put a number towards, like, what should that cost, right? Or how do I value that? But it definitely is something that impacts their future very, very positively.
Yes, absolutely. And I think you and I have talked about this in the past, where one of the things that I try to get through to my especially younger first time home buyers, especially the ones that are just starting to think about this, is the perspective they have on credit cards. And I always try to say a credit card is not out there to allow you to buy something you can't afford. What we are using these for is to create a resume of your ability to make repayments and establish that resume so you can get the best financing to do some of the bigger purchases and things
Yep.
that you need to do. And ultimately, those purchases have a strategy to build wealth. That's what
Correct.
ultimately real estate, my hope is that people will get into real estate, not only to create have a house for their family to grow up in, but also to build and create wealth through real estate. And
Absolutely.
so your resume that lenders use is this credit report, and to go into it with the perspective of, I need to, all my decisions here and the strategy that I have and the credit accounts that I get and the liabilities all have a plan around it and why you're doing it. And it's not just to get credit cards so that you can buy the things you don't have the money to be able to afford right now.
I agree.
All right. So our next question is, if you, let me see. Oh, if you pay off a collection, will it actually hurt your credit score? That's a great question because we get it every single day. If you pay off a
Yeah.
collection, will it hurt your credit score?
Possibly, right?
Yeah.
And this is why we'll go back to, like, it totally makes sense to consult with a professional before you start, making payments towards things. The full answer is that if you pay it and we don't work to get an agreement established that it's going to get updated, removed, and documentation provided that we're going to be guaranteed that, potentially you could pay for something, have that balance adjust down to zero, the date of last activity update on your credit report, and your credit score go down, right?
Yep.
So some of that detail is going to change next year with how it operates with the new credit scoring models, but for the most part, it just makes sense to say, let's, because here's the thing, my team that calls to negotiate on those things, that's all they do all day long, right? Like we are set up to negotiate and resolve a debt for the least amount of money possible for the best result that we can accomplish, right? And so if that's what we do all day, and you're pretty good at negotiating, but you've never done that, doesn't it just make sense to like hand it over to, you're still going to be involved, right? But for the minimum amount of money that you pay for us to lead you through that process, it's not worth the risk of not doing it the right way, because it could absolutely hurt you.
Yeah, and explain to me real quick, because I see this all the time where I have clients that thought they were doing the right thing, and they just went back and they paid off every collection that they had, regardless of the time that that collection had been on their credit report. And they come back to me and say, "Okay, I'm ready." And then we pull their credit, and everything that they had done, all their hard work, actually ended up putting them back 5 steps.
Yes.
That is why the strategy and the plan is everything. But explain what happens when you pay off a collection.
Well, again, if you don't negotiate to get it removed, essentially it just drops to a zero balance and it stays on there. And so a lot of times we'll have people come to us and they'll say, "Well, yeah, I have those collections there, but I mean, you see it, I paid it, it's at zero." And I'll go, "Okay, here's the problem, right? Like the zero, even though it's at $0, it's still reported as a collection on your account, right? The amount of money that's associated with your collections is has very little, if no impact on your credit score. So if you don't negotiate to get it removed, I had a situation where um, a lady and her husband were business owners, and at the start of COVID, things went crazy and they ended up losing it. It was very sad. But over the course of the next 2 years, they worked really hard to get back on their feet, and they did. They're like superhumans. They're fantastic, right? I got to know them a little bit through this process, and they went and they paid off every single thing that they defaulted on. One, because they felt it was the right thing to do because they borrowed that money, right? Which is very admirable.
Right.
Like I appreciate that so much and who that person is from a character standpoint. But they also thought that it was going to be how they could fix their credit. And so then after they did that, they ended up with us to say, "Hey, we've already done this. What's the next step?" And I had to be very creative about how I responded to it, because really I said, "Well, you just went and spent all the money that we could have used to negotiate on your behalf to get what we wanted out of that situation. Now that you don't owe Capital One, Chase Bank, right? Like these collection companies, this money, we have no leverage, right?" So with time, we were still able to clean some things up. But the problem in that situation is that we could have gotten to a better result from a credit score increase in a shorter amount of time, and definitely a dramatically smaller amount of money, because they spent, it was like 65 to 80 grand in cash to fix what they had. Right. And now, granted, some of that still would have had to been spent, but I bet we could have easily saved them 30, $35,000. I mean, it's just, so again, don't let the fact that you think that you know the right thing to do, right? And that you don't need the help to understand, potentially affect you spending 35 grand more than you need to, which you could have saved by a 5-minute phone call and discussion over your credit, right?
Yeah.
So, yeah, that's absolutely it.
And let me expound upon that. When a client comes to you, or if I send one of my clients to you, I always tell them, look, it's a conversation. The conversation isn't going to cost you anything, just to
Right.
get some information and figure out where the baseline is to start the repair. So so you do a free consultation call with your
Yeah,
clients
so that's where
initially.
we start with everyone, right? Because that's our only opportunity to really like uncover. what is your situation and how can we help if we can, right? So that's the other thing is we're not the credit repair company that's just going to say we fix everything. There's going to be times where it doesn't make sense for you to enroll in credit repair, and we're going to be the first to tell you, right? Like our goal, because we are an extension of Jennifer and our organization in this situation, is to be a good representation of what it is that she presents to you as her solution, which is an advisor, right? An overall opportunity for you to better understand this in the real estate world. How do you take advantage of that? It's not just buying a house. It's truly like future wealth building opportunity. So for us, we have to match that type of consultation with here's where you stand, here's how we can help. And that initial consultation is always free. And sometimes what happens is somebody will say, this is great. I love it. Awesome information. I need to save up some money. I'm going to pay down some credit cards and then I'm going to come back to you and we're going to do another review. And at that point, maybe it makes sense for me to enroll because I just
Got
don't
it.
have the money yet set aside to be able to follow through on the plan that we have. So
Got
again,
it.
that's all free. Like we're just working to direct people to what's the best opportunity for them to, follow through with their goal of credit improvement as quick as possible to get a house.
Perfect. All right. And that is something that initially, when I do a loan consultation, even though I am not you, I'm not a credit expert, I work in credit all the time. So I do a thorough review. We talk through the accounts they have and all the wonderful stuff that you've taught me. And then if there's a certain point where I see this client needs actual credit repair, then I usually introduce them to you and you take it from there. So. All right, one more question. What is considered a fair, a good, a great, and exceptional credit score? Everyone wants to know how to have a perfect credit score. So break that down for us.
So the thing is that these categories are defined in different ways by different companies. Like FICO has their specific but for me and understanding what I do about credit and who we serve with people that are pursuing a mortgage, I would say exceptional is anything that's above 720, right? 720, 740, 760. Once you hit that point, it's about as good as it gets, right? Maybe 740, 760. That's definitely in that category. I would say that good, right? Like or great, I would say great could be maybe let's call it 660 to that 720 threshold right in the middle. I think that's great for a mortgage. And then good, I would say, is going to be your 620 to up to 660, 659, right? Anything below that, like there's a lot of people that will say that they can get things and approval done at 580. And I think there's a lot of situations where I know people do have done that and great loans. But I think if you're looking at like, how do you put yourself in the best situation that the minimum is 620, 640, right? If you can get there, obviously people have different situations where they need to finance quick, right? And it makes sense. And if you can get approved and the loan officer likes the deal for you, then that's fine. 580, right? Get it done. But anything below that 600 threshold, I think that there's opportunity. And usually some pretty quick, easy opportunity to get above into those even mid sixes pretty quick. That's where I would put those three categories for sure.
And from a lender's perspective, there are loans that we can get you into that go down to 560, 580, like he said. But you have to understand that your credit score has a direct impact to your interest rate. Your interest rate has a direct impact to your payment. So I set the bar a little higher. I like to see, I call exceptional a 760 and above. And
Okay. Yep.
because there's an impact to your actual interest rate when you hit a 760, 740 to 760, there's an impact to your credit score. And then as we get lower, the products and the scores definitely reflect. So it is to your advantage to try to drive that score up as high as
Absolutely.
possible. Well, I just want to say thank you so much for taking the time to meet with me and for all the wonderful wisdom that you shared to all the consumers and realtors and everyone out there, including myself. And how does someone get a hold of you if they need?
So there's a few different ways. If you just want to check out our website, it's mycreditguy.com. My name is Jesse. My email is jesse@mycreditguy.com. And any social media, right? You'll find us on Facebook, Instagram. You can look up me individually. You can look up our company, My Credit Guy. There's plenty of different ways, avenues, and channels to get in touch with us. And if you do want to start with a credit review, you can get a hold of Jennifer. She can direct you our way, or you can contact us directly and just let us know that that Jennifer sent you our way, and we'll make sure that she's assigned in the system. But yeah, if you want to review, if you want to see where you stand, don't hesitate to reach out and get that set up with us.
Perfect. And is there any website on your website? Is there just good information that someone
Oh, yeah.
can get frequently asked questions and that information?
Yeah,
Perfect.
absolutely. And then on that, you can actually enroll in our newsletter where we send out weekly credit education content. And then also on YouTube's all of our videos around credit education.
Perfect. And then my name again is Jennifer, and my company's Radiant Financial Group. And we have a lot of wonderful credit information and stuff that you can sign up, and we'll send you that is in relationship with my credit guy. So if you just have questions on credit, or being a first-time home buyer, or buying an investment property, we're here to help. And my website is jenloans.com. And my number is 407-687-5285. So thank you again, Jesse, for being here. And we'll do another
Thanks for
one in
having
the
me.
future, but appreciate you
Yeah,
so much. Thanks for being
that
a
sounds good.
partner.
Appreciate you
All
too.
right. Thank
Bye,
you.
Jennifer.
Bye-bye.